Hello, in this video we are going to cover the difference between a fixed and a variable rate mortgage. So this refers to interest. So let's say you want to buy £100,000 property, you have a 10% deposit, which which is 100,000 times by 10%, or also 0.1 if you put into a calculator, gives you £10,000. That would be your deposit. The loan would be your total, which is 100,000 minus the 10,000. So that goes there, and that is from there. And you want to borrow £90,000. Okay, simple stuff. The bank isn't going to give you this for free. They'll charge you some sort of interest. Let's say if they charge you 5% interest, that means every year you will be paying, it's usually per year, you'll be paying 5. I think I can do a better 5 than that. You'll be paying, that's better, 5%. Okay, so that's pretty easy to get your head around. So there's two different types. So imagine if you have a 35-year mortgage. The principal is the same with a 25-year, 40-year, 6 months, doesn't matter. 35-year mortgage. If you have a fixed rate, that means the interest will be basically fixed. It will be fixed for a certain amount of time. Usually it's not for the entirety of the loan. So let's say if it's a 5-year fixed, 5-year fixed at 5%, that means for the first 5 years, the interest you pay is 5% on the loan. And then for the remaining 30 years, it goes to a variable rate. So now let's cover variable rate. So variable rate is interest rate that varies. I mean, there's nothing more to it than that. Obviously there are some more complex finance stuff around variable rate interest, and how it's actually calculated. The bank doesn't just sit there and be like, you know what, I think this guy can pay, a higher percentage than the guy previously, so I'm going to charge him 20%. It's not like that. It might feel like that sometimes, but it isn't. I'll cover, in a separate video how the variable rate is essentially, calculated and figured out by the banks. So just, take it at face value for now that the variable rate interest varies per year. So it can go up, it can go down. With a fixed one, you have that certainty that you are always paying 5%. So you might be thinking, why would you ever want to go variable from the start if they're going to go to variable afterwards anyway? Sound like fixed is good. Because imagine if you have a fixed rate of 5%, and over the first 5 years, let's say you have, on a variable rate interest, you have 10%, you have 15%, and let's say for the subsequent years, it drops down to 1%. So if we add all that up, that is equal to like 27. Divide that by, honestly this was not the best example to use. Let me rejig the numbers slightly. So if you have, let's say, 7.5%, and let's say you have 6.5%, so the first 2 years are higher, but subsequently the last 3 years are lower in that fixed rate period. So 7.5 plus 6.5 is 14, and plus the 3 ones is 17. But that's over the 5 years. If you divide it by 5, you will get your 3.4. So 3.4% on average. So on average, over the 5-year period, the variable rate interest in this scenario would be cheaper. But that means you are taking a gamble, you're taking a risk that the variable rate interest on average will work out cheaper than the fixed rate. So that's the risk you take with variable rate. Like I said, generally speaking, you will be switched back to a variable rate after the period. Like some of the common fixed terms are like 1 year, 2 years, 5 years. I've seen some as high as like I think 10 and maybe 15 years. But generally speaking, you won't get it for the entirety of the loan. The other thing to bear in mind is a fixed rate. Fixed rate is generally higher than the current variable rate. So this scenario was a bit loaded because I put the first year at 7.5%. It'll probably be more like, let's say 3.5%, so it's lower. But that doesn't mean it's going to be 3.5% the year after. It might bump up depending on how the economy is doing and what sort of stimulus packages they have to put in to the economy to boost it up, for example. So fixed rate can be, is generally higher at the start, but it can, overall work out cheaper. So the other thing is, you may have heard that a fixed rate mortgage, so after the fixed period cannot be, during the fixed period you can't remortgage it. I'll cover in a separate video more specifically what remortgaging means, but it's basically you get another mortgage that pays off your current mortgage, and the usual idea is to try and get a better rate, sometimes to borrow more money. The reality is you can remortgage even during the fixed period. There are some, things that you need to consider. One, you will probably be liable for an ERC, which is an early repayment charge. And also liable for an exit fee as well. But if the numbers add up and still doing the remortgage works out, then there's really no reason why you can't, at least no legal reason, why you can't do a remortgage. It's on the assumption that your bank, qualifies you for a remortgage, but assuming that's okay, you can do that. And that's really it between a variable and a fixed rate. One last thing I want to cover is put it here. A variable rate is also known as an ARM, which stands for adjustable rate mortgage. So if you ever come across, like a 5% ARM in the context of a mortgage, it means it is a variable rate. It is a variable rate mortgage, and they usually won't say like 5%, but if you come across a mortgage that says it's an ARM mortgage, and that means it's adjustable rate, and that just means it's variable. That's it. If you have any questions, as usual, feel free to hit us up on the Discord group. You can check out the finance channels, and as usual, I look forward to seeing you in the next video.